My role at HSBC is the one of an equity analyst, so I spend most of my day speaking to institutional investors about investing in listed telecoms operators. So I will try to bring this perspective over the next 10 to 15 minutes. So to start with, there are many aspects of the economic crisis, but here what I would like to focus on is one that is particularly relevant for companies and investors. And this point is that because of the crisis, capital has become an even scarcer resource. This is obviously a point that goes beyond the telecom sector, but the crisis has made funding more expensive and difficult in every sector. The chart that you see on the slide shows the equity risk premium, which has never been so high over the last 25 years, and it's still well above the average that we would expect. So the cost of capital for companies is increasing, and there is more and more emphasis on deleveraging the balance sheets. And this is also the case in telecoms. Now, I should say that deleveraging in the sector is by far not as serious as the one that the sector did experience soon after the technology bubble, but nevertheless, deleveraging has accelerated because of the crisis. Until 3 years ago, most operators were happy with net debt over earnings before interest, tax, depreciation, and amortization of 2.5 times. Now we see most companies targeting the same ratio at around 2 times. And just to put it in perspective, normally if you are between 2.5 and 3, that would be enough to gain investment grade from the rating agencies. So telecom is capital intensive in a moment where funding is more difficult and capital is scarce. And the challenge, in our view, is to really try to regain investors' backing. The technology cycle continues to progress, potentially risky for companies to lag behind if they stop or slow down their investments. And at the same time, the CapEx requirements are rising. Our estimate is that if you look at the European telecom sector as a whole, during the 2 years of the crisis, so 2009, 2010, operators have invested roughly 6% less than they did in the 2 previous normal years, 2007 and 2008. So that's roughly about 6 billion euros less CapEx in the overall European sector. There are opportunities, growth in mobile data traffic, and also in wireline we see over-the-top content distribution more and more developing. So these do represent an opportunity, but it is also putting increasing pressure on operators to commit to higher CapEx. Just to back up these fundamental two trends I've mentioned, there's a chart there. Cisco is forecasting essentially mobile data traffic to double every year over the next 5 years. And if we do our analysis of increasing usage versus CapEx over sales globally, we see that the US and Japan really show the way. If the European markets are going to see their usage growing towards the same levels that US and Japan experience today, CapEx over sales are likely to need to rise. But the reality is, and I apologize if the chart is a bit dark, but the reality is that it has been a dismal decade on the financial markets for the telecom sector. Over the last 10 years, the sector has underperformed the, so if you take the telecoms sector index, that has underperformed the general index on the stock market by just below 30%. So for what we observe, telecom sector share price performance has never really recovered from the technology bubble burst. And the challenge, therefore, is to persuade investors to back and endorse operators' capex, despite funding being more expensive, and in the wake of what happened during the technology bubble, where the sector has burned a lot of capital, both financially and in terms of reputation. So our view is that unless the sector is able to show some revenue growth, it is unlikely that investors will show commitment for the additional capex that the industry requires. So looking at the different markets globally, it seems to us that there is a clear correlation between regulatory transparency and investments. If the regulatory environment is transparent and supportive, it is easier to commit capital. This is very important because for some projects like fiber deployment, for example, the investment has to come before there is clear evidence that capex is monetizable and justified. In the charts that you see in that slide, you have the example of NTT. Most of the capex started to be quite intensive in the first half of the decade, but the impact on their KPIs wasn't evident until the second half of the decade. In the United States, Verizon and AT&T have benefited from a pro-investment regulation promoting fiber investment. And regulation has thus enabled the United States to keep up with fiber deployment that we have seen in Japan and Korea, and therefore to remain strategically competitive. So here we should ask ourselves, what drives innovation in the sector? And I'm very pleased to have found this vintage cover of Bill Gates on the Time. There has been a lot of innovation at the software level in the industry. And in relative terms, it is generally easier to innovate at the software level. But a fair point to make is that not all the innovation comes from software and internet companies. And we cannot ignore the innovation needed in the telecom sector. So the problem with innovation in the telecom sector is that it's expensive, it's time-consuming, and it's riskier. Therefore, it requires a supportive environment. Software innovation also requires innovation and investment in the telecoms infrastructure to continue and progress on their development path. So the key question is, what sort of competition do we want in telecoms? The competition introduced in telecoms through unbundling is based on regulatory established price arbitrages that disincentivize investment in infrastructure, because everyone can use the incumbent infrastructure at the incumbent's unit cost. So all the competitors use the same input, so there is limited scope for service differentiation. Hence, competition becomes purely based on pricing. And the resulting price pressure means that competitors rarely make enough to justify investing in infrastructure themselves. So unbundled-based competition does not provide, in our view, the right incentives for innovation and investment, and therefore looks to be not self-sustaining. Our view is that regulation should promote infrastructure-based competition. So given the enormous difficulty and expense involved in deploying networks, there may be a good case for opening up ducts and infrastructure, provided that a reasonable price is set, but incumbents accustomed to seeing their infrastructure handed to rivals at cost-based prices are very cautious about committing more capital to deploying new infrastructure. And unbundling fiber-based networks discourage investments by both incumbents and non-incumbents. At the same time, we think that regulation should not penalize non-incumbent infrastructure. Unbundling is particularly unfair to smaller infrastructure players like cable that have committed capital over time but are still smaller scale with higher unit costs than the incumbents. Now, regulation has shown so far to be keener in a way on lower prices competition, and they seem to have neglected this side of the industry, cable, which has gone through a lot of financial distress because they have built they've tried to build a parallel infrastructure. So if incumbents are forced to sell access to alternates at their unit cost, so at the incumbent's unit cost, cable operator will be disincentivized to invest and extend the footprint, as their unit cost is inevitably higher than that of the incumbent. So the point that we would like to make here is that if there must be fiber unbundling, rates should not be set at the unit cost of the incumbent, which is the largest scale operator in the market, but instead they should be set with reference to those of the smaller infrastructure competitor, which is cable, and that would provide the right incentives for infrastructure investments. Finally, before we move on to the Q&A, just a slide on net neutrality. I know there will be a lot of talks about net neutrality later on, but here, it's just to emphasize that it may be a business opportunity. So again, in an environment where capital is scarce and funding is required, it can be an opportunity to explore. And here the questions we would like to ask is, what's wrong with data packet prioritization? It's not something that we have seen specifically in telecoms. It's something that is an approach which is common in other industries. Look at transport. You pay more if you want a better service. And also traffic prioritization is an essential element of good network management. So it's very hard to discriminate when an operator is doing it for good network management or when it's doing it for a purely commercial reason. So, and also, lastly, we think that with the development of over-the-top video content distribution opportunities, a strict interpretation of net neutrality may not even be in the interest of internet companies, as they may see a business case for buying quality of service and therefore have access to that form of prioritization, which would enable some of them to become the video platform content provider of choice. So I'm going to leave you there and try to be as brief as possible, and I'll move on to the Q&A.